Blue Owl Capital net income holds steady in Q4, outperforming the sector. This article was written by ADS Analytics. Summary: Blue Owl Capital delivered stable net investment income in Q4, with a total NAV return of 2.7%. OBDC trades at a 10.9% total dividend yield. The company targets upper middle market borrowers and has a diversified portfolio with top sectors, including software, insurance, and food beverage. Portfolio credit remained resilient, with low non-accruals and a small net realized loss. Valuation has moved out to a small premium. We would wait for a pullback for adding to our position. In this article, we take a look at the business development company Blue Owl Capital Corp, OBDC. The company recently completed a merger with its sister public BDC, OBDE, delivering a chunk of alpha to OBDE shareholders, as we discussed in a recent BDC Weekly. We last covered OBDC here and maintain a hold rating on the stock. Over Q4, OBDC delivered stable net investment income despite the downward trend across the sector, with a total NAV return of 2.7%. The company has a price net investment income yield of 12.3% and a total dividend yield of 10.9%. It trades at a 1% premium to book. OBDC targets borrowers in the upper middle market space with a weighted average EBITDA of $202 million in its portfolio. Its top sectors are software, insurance, food, beverage, and others. Quarter update: net investment income was flat from the previous quarter. A good result in light of a percentage drop in the mid-single digits across the sector. One-off items that buoyed income included accelerated OID, i.e. original issue discount, and a dividend from a small equity position. Overall, this kicked in an additional $0.03 over and above the historic run rate. There is likely to be additional pressure on the supplemental from lower SOFR, given the usual accrual lags, so net investment income is more likely than not to fall next quarter. The dividend remained the same, a 37 base and a 0.5 supplemental. Total dividend coverage was 112%, with the base dividend coverage at 120%. We expect the base dividend to be safe. The spillover was 0.39 times, slightly above one regular dividend. The NAV fell 0.1% over the quarter. It has remained broadly stable over the last few years. The drop in the NAV was largely due to the sum of realized losses and unrealized depreciation being higher than the level of retained income. Management touched on the situation around tariffs and the DOGE-related reform, saying that the portfolio has limited direct exposure to companies that engage in manufacturing, import goods from abroad, or direct government contractors. This is fairly typical of the broader sector, with most BDCs focusing on domestic service sectors like software, healthcare, and others. Management said they plan to file for a $750 million at-the-market equity issuance program. The stock is trading at a small premium, so this could make sense and be a cost-efficient and NAV-accretive way to raise new equity. The company mentioned that the past year presented several challenges, such as a low amount of M&A deal flow and spread compression. Both of these remain headwinds to income, and while the former may be picking up, tight spreads remain a challenge for the broader sector. Income dynamics: net new investments were pretty flat, echoing the move in the previous quarter. Leverage fell slightly, though it remains above the average in our coverage. Both asset and liability yields fell given the trajectory of short-term rates. OBDC has an above average of floating rate liabilities, so it will enjoy a slightly quicker fall in interest expense. The overall level of interest expense of 5.4% is relatively low, both in absolute terms as well as relative to the median in our coverage, which is around 6%. The company is still taking advantage of the low-yield post-COVID environment. Its recent tap of the 2029 bond at around 6% shows that it can currently fund itself 0.6% above its overall level of interest expense, driving about 0.6% of excess net interest margin for shareholders. Management said that the portfolio experienced a drag of about 0.45% in base rates and another 0.25% in spreads. As far as the 3 Fed rate cuts, about 70% of that has been so far passed through to income. This suggests some further downside to net investment income, particularly if we don't see similar one-off gains over the coming quarters. The company tightened the pricing on its revolver by 0.225% to SOFR plus 1.65%, which is nice to see and will be a small tailwind to net income. It also took advantage of tight credit spreads to reopen its 2029 unsecured notes and raise an additional $400 million, in part to refinance the 2025 notes at a spread of 1.63%, the tightest unsecured borrowing level the company had ever achieved. That said, the refinancing will increase overall interest expense, given the 2025 notes carried a fixed coupon of 4%, whereas the company is paying around 5.9% on the refinancing. Lending spreads appear to have stabilized over the last few quarters. There is still negative momentum in the portfolio, however, as repayments are largely coming from loans acquired at wider spreads over the last few years, which continues to push the weighted average spread of the portfolio lower. Portfolio quality. Non-accruals fell for the third quarter to 0.4%, well below the average in our coverage. Pike was not much changed. The level is elevated relative to the median in our coverage. The company said that the vast majority of Pike was structured at inception as a loan feature, i.e., it is not problematic Pike. Portfolio quality, as gauged by internal ratings, fell slightly. There was a small net realized loss during the quarter. Interest coverage rose to 1.8x across the portfolio from a 1.6x trough. Amendment activity was flat over the quarter. Valuation and returns. The company has been performing well, outperforming the average BDC in our coverage over the 3 to 5 year horizon in total NAV terms. The stock has tended to trade at a discount. However, recently the valuation has risen to a small premium. The stock looks somewhat cheap against the average valuation blue line. However, this is arguably overstated by the enormous re-rating of Maine and HTGC. On a median basis, the stock looks expensive. Stance and takeaways. We initiated our OBDC position when it was trading at a double-digit discount. We then rotated mostly into OBD, which, while very similar to OBDC, had tended to trade at a wider discount than OBDC. The merger of the two companies delivered additional alpha and increased our OBDC position. The current valuation is fair relative to the sector and is reasonable for starter positions. We would look to add to our position at a mid-single-digit discount. This article was written by ADS Analytics,